Thanks for tuning in to Talking Point Unfiltered, where we try to have long conversations, slow conversations about meaningful topics which are impacting either the investing world or the corporate world. In today's show or today's episode, Hiren Ved of Alchemy is our guest. Hiren, so good having you. Thanks for taking the time out.
Thanks, Niraj. Thanks for inviting me. Always a pleasure.
Thank you. The pleasure is ours. I can tell you that. Unprecedented times, or uncertain for sure, are these unprecedented as well? What's happening around the world, the weakness in the dollar, for the first time since 1990, that there is a bit of a dichotomy or a strong dichotomy between what the US yields do and the dollar does, and the implications, investing implications for all of this, Hiren.
Yeah, Niraj, I mean, truly, I think we are in very interesting times, as they always say, but there are a lot of underlying tectonic shifts that, I mean, some of those trends have been in motion for some time, but sometimes you need a trigger to accelerate these trends, right? Like, for example, in India, demonetization was the first trigger to get digitalization going, right? And then COVID actually accelerated it. And I think if you look at the global stage, the Russia-Ukraine war, COVID, and now the latest is the Trump trade and tariff policies, is significantly creating a trigger for some long-term tectonic shifts globally, right? I mean, just imagine when President Trump won, and the overwhelming thought at that point in time was that the dollar is going to rise because he's going to turbocharge the US economy, he's going to cut costs, he's going to deregulate, and everybody would want to rush to invest in the US. And look what we are seeing right now, is that there is massive uncertainty in global financial markets because of the tariff policy. The dollars got knocked off like I haven't seen in the last few years.
Exactly.
Gold is at an all-time high, ripping. Confidence, I'm sure, in US businesses is shaky, because how can you plan anything, in this kind of an environment? We're talking about a potential recession in the US hitting. China isn't blinking in the trade war. So I think it's very interesting times that we are seeing. And I think sitting here today, it may be very difficult for us to fully grasp what this could entail over a long period of time. But surely this will have some implications from a macro perspective. Maybe this could mean threats to certain industries. Maybe this could mean massive opportunities, because big change always brings in its wake, big opportunities and some threats which are lurking, which you don't know, which probably play out over a period of time, right? So it's indeed very interesting times to be an investor in these times, for sure.
Yeah, but some of the trends are stuff that we haven't seen, Hiren. So what are the investing implications of the same? Like, we haven't seen Europe trying to reflate for such a long time. We haven't seen the dollar weaken the way it has in a really, really long time. What are the investing implications for an emerging market investor in India, or an emerging market investor wherever, but also in India, or for a fund manager like you, who's investing large sums of money, and global money at that, sitting in India and Indian businesses?
So we hope, for the longest time, EM investors were waiting for a crack in the dominance of the US stock markets and the dollar, right? Because both are very important if you want to shift capital out of the US. The US is the magnet of capital around the world. As they say, it has a dominant share of the global market cap. The 7 mega caps have a dominant share of that market. And US is the reserve currency of the world, right? And therefore, I think that post GFC, if you look at it very objectively, there was real no case for investing in emerging markets, because on a dollar adjusted basis, EMs really didn't deliver any great fantastic returns versus the US S&P. Now you could argue that probably India came the closest, to delivering probably similar to slightly superior returns than the S&P 500 in dollar terms, which is in itself a great thing.
Of course.
But, that's all great consolation for people like us sitting in India. But I think the big, as I said, if US investors think that the dollar is likely to remain weaker for a longish period of time because of this tectonic shift in the trade policies, and that President Trump wants a cheaper dollar so that they can reorient the economy, then I think one of the implications could be that some of the EMs could get more money. Right now, because at the first instance, you don't know where this should go. Unfortunately, it's not even going into treasuries because the yields are spiking. Ideally, if the money went into treasuries, the yields should be falling.
Yes.
And maybe eventually they will. But it's landing up in things like gold and crypto, right? And I hope that eventually it will get into some emerging markets. I'm sure I want to be hopeful that India will find its fair share of capital coming back.
Hopeful or sure?
Both.
Both.
Hopeful in the near term, sure in the medium to longer term. Because I think you still have a large economy, which will still grow at 6-7% in real terms and 10-11% in nominal terms. 1.4 billion people, knocking at the doors of $3,000 per capita. Not a bad place to be in, I would guess.
Not a bad place to be. In fact, that would be my question, right? For past returns would seem that China hasn't necessarily been the best investment destination.
Yeah.
Can it change because they have some serious tech advantages right now and natural resource advantages, so on and so forth. But even if that were to be the case, some other large markets like India would definitely be there because there is stability, low beta, large market, all of that India provides, right? So suffice to say.
And we always try to gauge these things by saying India versus China. It's not really India versus China. It could be India and China. It could be more of India or it could be more of China, but it could certainly be India and China both. I think, China is also going to be a large domestic economy. It's not it's the second largest economy in the world. You can't ignore, right? And obviously, you rightly mentioned that they have clearly shown that, they can double down on their technological prowess, and the more you deny them high tech, the more is the incentive for them to build something with a vengeance, right? So I don't think you can ignore China. Maybe US capital may not go into China for some time given the hostility, but I guess it's a country that you can't ignore. But let's talk. I think from an India perspective.
Just before you do that, sorry, and we will talk to the India thing in just a moment, but just a word out here, Hiren. A lot is being made, or a lot of fear about that the first mover on technology, whether it's US or China, right, will get all the spoils. So much chatter in normal conversations, WhatsApp groups about how India is not doing this, ये नहीं है, deep sea China में है, otherwise it's in the US, natural resources नहीं है. Is it that material over the long term to be the first mover on technology? It may be material, but could eventually technology become a commodity, and therefore multiple companies and multiple economies might benefit out of it? Would that also be a possibility?
If you look at it, every technology eventually has become a commodity, right? Because unless technology permeates into everyday business and helps in productivity, cost cutting, or improving returns, it is not an end in itself, right? What do you do with the technology? You have to use it and make it useful for people, right? So, but yes, there are a lot of early gains to be had if you can be a pioneer in that technology. But Niraj, I think we're still, India is trying to do a lot of things, but to do what the US or China have achieved, you need 2 or 3 things. You need focus, you need a lot of capital, and when I say capital, it could be private capital, and it could also be state support, right? I don't think any of what China has achieved, or for that matter, even some of the bleeding edge technology that the US has achieved, could have been achieved unless there was a collaboration between, let's say, research institutions in the universities and the labs, and the private sector collaborating with each other. So you have to build that ecosystem. So I think the reason why you got the most innovative companies out of the US is because you had risk capital available in the valley. You had great entrepreneurs which were willing to take risk on new tech, and you had an ecosystem where R&D was, there's a lot of research that happens between academia and government funded institutions and the corporate sector. And then it takes years to develop that ecosystem. And then you need a few success stories, which then enables other investors to take further risk. So if somebody made money when databases were big, then somebody else would take a shot at it. Then, ERP, then cloud. Now we're talking AI, right? So every wave of technology eventually has become a commodity. But if you were ahead in the game, you got those monopoly profits for a few years, and then things settled down, and then it proliferated everywhere, right? So every technology also has a curve. India always participated when the technology became, or helped to become the technology, or helped to make the technology become a commodity. By using that through our IT services engine to help other companies drive productivity from those technology shifts. And that's where we are. But now we are setting a little bit of our ambitions higher. Does it match up to what some of these large, countries have done? Maybe not, but we have to start somewhere. And I think we are at least starting to think with our AI mission. We are trying to put $1 billion, $1.5 billion and trying to build our own LLMs. We are now taking baby steps towards manufacturing our own semiconductors through that mission. So we are far away. We do have some successes up our sleeve. We've done phenomenally well in space tech. I think our missile technologies are great. So there are some areas where we are ahead, and there are many areas that we need to play catch up. But you need a very strategic intent. Like when China tries to do this, and I was listening to this All In podcast, I'm sure some of you also listen in. And, China had laid out a goal of becoming a leader in AI about 15 years ago. And they started to place their bets. And the goal was that by 2030, they want to be a leader. And I think very recently, they've already surpassed the amount of, general scientific spending on R&D that they do. They've surpassed the US, right? So you require a very long-term strategic thought process to achieve that kind of stuff. I guess we are a little bit far away from that. I think we are capable, but we just need to put all these elements in place.
Okay, so then let me bring it back to the point that you were saying, that let's think of it from a perspective of somebody who's sitting in India, investing into Indian companies. How does he make sense of all that's happening and decide the investing implications here on?
So, yeah, I mean, I think if you look at, sitting in India, probably it's difficult to take a bet on leading edge technologies, right? So probably you have to go and participate in investment opportunities either in the Valley or in China or Israel or wherever these cutting edge technologies are being made. And, some very evolved family offices today have the ability to export capital and invest there. But for people like us, I think one way to do that is more like a picks and shovels approach, right? So let's take the example of AI. And I don't think sitting here we can invest in an open AI fundraising, or, you will not have access to any of those opportunities. And that's a very different game that people play. But you could invest in a company that builds data centers, for example, because if AI is going to proliferate in government, in business, then people will have to set up the physical infrastructure to build AI. So you could invest potentially in a company. We've done that in one of our AIFs where we do invest in some private investments, right? We've been early there. Or you could invest in maybe a software company which is using AI. And AI opens up an opportunity where they can help to build or architect solutions for, let's say, the top Fortune 1000 companies. Or, for example, we've invested in a listed, again, I won't take a name, but a data analytics company, which actually comes first in line, because if you want to use AI meaningfully in your organization, you first have to get your data in place, because what will you train the AI model on? You have to train the model on some data.
Right.
And you don't want your data, that's your proprietary data, then you need somebody to actually help you with setting your data sets right, making it meaningful, on which you will run an AI model, and then you would say, okay, this is how I will benefit because of AI in my organization. So that's a picks and shovels approach. That's one way to do that. The second is you keep your eyes and ears open, because there will be companies who will start to think and architect how to use AI in their own business to make themselves competitive. I mean, very recently, it's now public knowledge that, I think late last year, the Bajaj Group made a presentation and they showcased how Bajaj Finance is trying to use AI in many of their processes, with the end goal that they should be able to bring down their cost to income ratio substantially, right? That can give them a big competitive advantage. Or for that matter, let's say a Zomato can use AI in its processes, or some other company can use AI in its processes and and substantially drive productivity, which gives it an edge over some of their other competitors. And then you suddenly have this differentiation within the same sector where companies are improving their competitive advantage, and some who are not able to use that will lose their competitive advantage, and eventually they will lose value, right? So I think from our perspective, sitting here in India, it's either you try and identify what I call as the picks and shovels approach, what goes into building something that is growing very fast and is going to be all pervasive, or you see the net beneficiary of that technology being embedded into your business, which gives you some edge over your competitor, right? And that helps you to enhance and create value.
Very interesting. Can I also talk a bit about what have traditionally, as you said, been the enablers of technology for corporate India, and which is, or corporate India, not just corporate India, corporates around the world, which is IT services. And what happens to that business in light of this new world order wherein there is AI, there is a presumably weakening dollar, and maybe in the near term, slower growth, in the US at least?
Yeah, I think, at the very first level, when we think of this, I think so there are 2-3 things, right? One is that, let's keep aside things like a slowdown in the US because of the uncertainties, because that's a cyclical thing.
Fine.
It's not the first time it has happened. US goes into a slowdown, tech spending goes down, order inflows get delayed, companies slow down, earnings get downgraded, blah, blah, blah. We've been there, right? That tape is played. I think what's more significant, what happens to the model of IT services companies in the wake of AI?
Right.
Right. At the very least, one thing seems very clear, that the arithmetic relationship between revenue growth and people dies down completely, right? Which means that your model has changed. I think talking to at least what we've tried to do, talking to some of the people who we respect in this industry, to me, the model at the first instance will change from what they call the FTE model to a fixed price model. I want to achieve this objective. What would it cost to do this, right? And then it doesn't matter whether you use an AI tool. Instead of using 200 people to run the project, you do it with 20 people. You deliver value to the customer, and it may have no bearing on what resources you use, because today you could use a lot of automated technologies. You don't need coders to write code. The code will be written. But you need somebody to architect what kind of AI technology do you, how will a bank use AI versus how does a retailer use AI versus how does a drug discovery company use AI in its process is different. So it doesn't take away the fact that you will need people with deep domain knowledge. It doesn't take away the fact that you will need people who can architect a solution. What changes is your relationship between revenue and costs and how you build the model, right? So I think there will be winners in that as well, because you will still need somebody who you will need to run. Because today when I talk to a lot of the software companies, IT services companies, they say that, we're getting a lot of small projects from our customers who are still experimenting and running, small models to figure out what can come out of this, right? Nobody is giving you a $5, $10, $15, $20 million AI project today. But everybody is doing smaller projects to figure out what they
kind of pilots.
Pilots, right? Now, this could evolve into something big. And I think that, so one company, and I won't give a name, and they said that, look, I think we will be able to maintain our margins because we will be able to cut costs. We don't need so many people. But whether we will be able to grow our revenues, in the historical context in which we grew our revenues at a point in time, that we don't know, right?
Okay.
And something like when, my guess is, going by history, when something like this happens, you get a massive consolidation in the industry. So let's say you have 4 or 5 big players today. Maybe 5 years down the line, you don't see that many big players, and you may see either many mid-sized, very specialized players, somebody very focused on healthcare, somebody very focused on banking, somebody very focused on high tech, or you have a few big guys, who can help you to architect things. So I don't know, but I certainly see, we are already seeing that. We are seeing a challenge on top line in IT services. It's very difficult now for them to even grow in late single digits.
Agreed. For FY26 for sure.
Correct.
So therefore, size may not be an advantage out here, right, Hiren? Traditionally, size has been an advantage. Here, maybe being nimble-footed might actually be an advantage.
I agree. And, so these companies will, unless it's very difficult for you to completely, I can't imagine them being a completely different company.
Got it.
Right? So they will become nice cash flow, dividend yield companies, like utility companies.
Does that excite Hiren Ved? No.
Not really.
Not really. It's fascinating to know all of this and more. Hiren Ved, lovely having you on Talking Point Unfiltered. Thank you so much for your time and your wisdom.
Thanks, Niraj. It was a pleasure.
The pleasure was ours. And viewers, thanks for tuning in to yet another fantastic episode of Learning on Talking Point Unfiltered.